Good morning, good afternoon. Welcome, one and all, to this presentation. We're here 5 minutes before the hour, just getting all the technical situations situated. We'll be starting momentarily. Thank you for joining.
Line wasn't true, and you passed them by. Now you're innocent, me, and there are lines that make me want to let me try. Let me try. Now I know where a line is. I don't even all I some girl that I needed in this world. You are the one for me. One for me. Hold you in my arms, girl, and fill you with my charms. I'm sure we'll see. We'll see. The thing I'll say are true.
Don't you love it when things are both easier and more
All right, family, we are about 2 minutes before the start. As those be joining in on us, just bear with us a few more minutes.
Did you know GoodRx can help you save on medication, manage prescriptions, and get trusted health information? If you're one of the millions living with a heart condition, check GoodRx for an easier, more affordable way to manage your health. GoodRx offers common heart medications for under $30. Just search for your prescription, find the best price, then show your pharmacist the GoodRx coupon. And it works whether you have insurance or not. To start saving and better manage your heart health, download the free app or visit GoodRx.com today. GoodRx is not insurance but can be used instead of insurance, including Medicare and other federal and state funded programs.
Mhm. All right, all right. We are at the 6 o'clock hour. Just waiting for a few more people to join in with us. And we're gonna get started here. All right, all right. Okay, and welcome once again, one and all, to this Investment Matters series. I am your host today. My name, for those who do not know, again, is Benjamin Levy. I'm a financial advisor, aka Rabbi. Now here tonight with my financial hat on today, as I am an independent financial advisor under the umbrella of 1847 Financial, HTK. And we have a dynamic presentation for you tonight. For those, again, that did sign up for this series, which we do on a monthly, every third Tuesday of the month, we are here. And so today's series is the 5 smart investment strategies. When it comes to investing, there is no shortage of theories, approaches, and ideas. Visit the bookstore and search online, and you may be overwhelmed with information. So today, the 5 smart investment attempts to simplify the investment process. We're going to review 5 strategies showing you how they can help guide your approach to the financial markets. While there's much to be learned about how markets operate and function, understanding a few strategies may be enough to help get you on the process. So again, my firm, we have a wide range of services with primary commitment to helping clients pursue their unique financial objectives. We want to help to develop an overall strategy tailored to your goals, your risk tolerance, and your time horizon. So again, for those who may not know, I have over 20 years of experience in the field of financial advisory. I started my career off as an auditor with Deloitte and Touche for several years. And I became a financial professional with New York Life as a life insurance agent. Got my insurance license and then moved over and got my investment license as I'm working with Merrill Lynch for several years. Continued on to where I am today as an independent, again, financial advisor here at your disposal, licensed in several states, primarily in Pennsylvania, New York, New Jersey, North Carolina, Florida, South Carolina, and several others. So, wherever you may be, we can definitely assist. This firm is dedicated to helping individuals evaluate their financial situation. We want to provide people with tools that can help them make informed decisions. We offer informational materials on a wide range of topics because we understand that individuals have diverse financial needs. If you have any questions or concerns during the course of this presentation, we invite you to take advantage of our complimentary consultation. During the consultation, we can discuss your questions and begin the process of helping you develop a financial approach that will address your individual needs. Keep in mind that the information in this material is not intended for tax or legal advice. It may not be used for the purposes of avoiding any federal tax penalties. Please consult a professional for specific information regarding your individual situation. So let's jump right in, get right into it. Again, as we go through this, if you do have any questions, just please drop them in the chat. We will address them before the presentation is over. So what are we talking about today? We're talking about 5 smart investment strategies. And what are those 5? As you see them on the screen there. 1, don't time the market. 2, asset allocation. 3, investment selection. 4, dollar cost averaging. And 5, rebalancing your portfolio. Now, while there may sound many investment approaches, we're going to review these 5 that have a potential to benefit the greatest majority of investors. Understanding these strategies can help improve your portfolio long-term results. So please take notes as we go through this. Again, the first one, don't time the market. Missing a few of the market's best performing days can reduce your portfolio's overall return. Number 2, review your asset allocation. Asset allocation is the process of dividing your investment dollars among several asset classes. Please write that down, asset classes. We'll explain more what that is. While this may sound simple, it's a bit more sophisticated than you may think. Asset allocation is an approach to help manage investment risk. Again, key words there, investment risk. Write that down. Asset allocation is not a guarantee against investment loss. Number 3, choose appropriate investments based on your individual situation. There are a wide variety of investment options available in the marketplace. Selecting the appropriate tool for your portfolio can be a challenging proposition. And number 4, remember dollar cost averaging. In short, dollar cost averaging is the process of investing a fixed amount, I repeat, a fixed amount of money in an investment vehicle on a regular basis or interval. Regular, typically monthly, for an extended period of time, regardless of the price. Highlighting regardless of the price. Keep in mind that dollar cost averaging does not protect against the loss in a declining market or guarantee a profit in a rising market. Investors could evaluate their financial ability to continue making purchases through periods of declining and rising prices. The return of principal value of stock prices will fluctuate as market conditions change. Shares, when sold, may be worth more or less than their original cost. And finally, fifth, considering rebalancing your portfolio. Over time, a portfolio's risk profile, I repeat, the profile may adjust due to the performance of certain investments. Rebalancing may help a portfolio better reflect the investor's goals, risk tolerance, and time horizons. All right, so that's what we're covering today. And let's move on to the next slide. As you see on your screen, fear, greed, and market timing. What are we talking about? So let's take a closer look at market timing. Okay, market timing is an attempt to follow one of the oldest maxims in investing. What? Buy low and sell high. As the illustration shows, perfect market timing would require you to buy when the market bottoms and sell when the prices nears its peak. However, it's difficult to know when the market is about to turn higher or lower. All too often, what do investors do? Investors buy the market is reaching its peak when enthusiasm in the market is at highest, and then they sell after a steep drop. If you agree with that, put a 1. If you don't, put a 2 in the chat there. Investing is emotional, as you see here, like a roller coaster, if you will. Investors who attempt to time the market can have success over a short term. However, over a long term, it can be a difficult strategy to follow. So this illustration is a hypothetical example. It is not representative of any investment or combination of investments. The actual results will vary. So missing the mark. What are we looking at here? The S&P 500 is the typical or most common benchmark which we use to measure how your portfolio is performing. So as you see on the screen here is the average annual returns from 1995 to 2015. So let's look at this. The cost of market timing can be high. This chart shows the standard S&P 500 Composite Index total return had an average annual return of 7.68% for a 20-year period, started in 1995 through 2015. However, investors who missed the 5 best trading days during the 21-year period and an average annual return of 5.49%. Investors who missed the 10 best trading days had an average annual return of 4%. And the investor who missed the 20 best days had an average annual return of 1.57% over a 20-year period. Are we suggesting all investors stay in the market all the time? Certainly not. However, the chart does show that missing the market's best days can have an influence on overall returns. Keep in mind that the return of principal value of stock prices will fluctuate as the market conditions change, and shares, when sold, may be worth more or less than the original cost. Stocks are represented by the Standard & Poor's 500 Composite Index, the average rate of return, are unmanaged index that is generally considered a representative of the US stock market. Index performance is not indicative of past performance or particular investment. Past performance does not guarantee, I repeat, does not guarantee future results. Individuals cannot invest directly in the index. So let's look at the power of asset allocation. You see here another investment strategy that has the potential to influence your portfolio's overall return is asset allocation. Asset allocation is an approach to manage investment risk. Write that down. Investment risk by what? Diversifying a portfolio among major asset classes. When I say asset classes, what am I talking about? An asset class would be stocks, bonds, cash, cash alternatives. Stocks, bonds, and cash alternatives have different levels of risk and potential returns. Keep that in mind. Over any period of time, one asset class may be increasing in value while another may be falling. Both asset allocation and diversification are approaches that help manage investment risk. They do not eliminate the risk of loss if securities prices decline. One landmark study showed that up to 91%, I repeat, 91% of performance of an average portfolio is determined how the assets within the portfolio are allocated between different investment classes. Only 8.5% has to do with specific security chosen. And again, past performance does not guarantee future results. So selecting among the asset classes we just talked about, asset allocation can have an influence on the portfolio's overall returns. Here's a look at each major asset class. Cash equivalents are investments that are readily convertible into cash. Some consider money market mutual funds as a cash equivalent. Money market funds are not guaranteed or insured by the FDIC or any other government agency. Money market fund seeks to preserve the value of your investment at $1 a share. However, it is possible to lose money by investing in a money market fund. Money market funds are sold only by prospectus. You should consider the charges, the risks, expenses, and investment objectives carefully before investing. A prospectus contains this and other information about the investment company that can be obtained from your financial professional. Read it carefully before you invest and send money. Now, fixed income. Fixed income tools are vehicles that offer fixed payments. Some fixed income tools have contract limits, have fees, charges, include account and administrative fees, underlying investment management fees, and mortality and fees expenses. They may also have surrender fees if you withdraw the money in the initial years. Bonds. Bonds are debt investments that are issued by the federal, the state, or the local governments, government agencies, and corporations. Those who invest in bonds receive interest. Write that down. Interest payments until the bond matures, at which time the investor's original principal is repaid, barring a default by the issuer. The market value of the bond will fluctuate with changes in interest rates. As rates rise, the value of existing bonds typically fall. If the investor sells a bond before maturity, it may be worth more or less than the initial purchase price. With stocks, the return and principal or value of the stock price will fluctuate as market conditions change. and shares when sold may be worth more or less than the original cost. Investment seeking to achieve higher yields also involve a higher degree of risk. So what is the investment selection process? With basic understanding of the asset classes, the next step is the selection process, allocating assets among major classes. The problem is that within the major asset classes, there are thousands of investment options. Many wonder where to begin. The best place to start is to consider your investment goals, your risk tolerance, and time horizons. If your time horizon is less than 3 years, certain asset classes may be more appropriate than others. If your time horizon is 20 years or more, you may be able to consider a wider spectrum of asset classes. So let's look at a long-term look at performance. You see the chart here. When you look at short-term, the top performing asset classes can change from year to year. And that's what this chart shows. From 2005 to 2006, stocks had the top average annual return. In 2007, bonds were the best. In 2008, cash equivalent or cash alternatives had the best returns. In 2009 and 2010, stock fared best. In 2011, bonds again took the top honors. Finally, in 2012 through 2014, stocks won out. So over any 1 year period of time, one asset class may be increasing in value while another may be falling in price. By allocating assets among investment classes, investors are looking to generate the highest potential return based on their investment goals, investment risk tolerance, and time horizon. However, asset allocation is an approach to help manage investment risk. It does not guarantee against investment loss. Stocks are represented by the S&P 500 Composite Index Total Return, an unmanaged index that is generally considered a representative of the U.S. stock market. Bonds are represented by the Citicorp Corporate Bond Composite Index, an unmanaged index that is generally considered a representative of the U.S. bond market. And cash is represented by the Citigroup 3-month Treasury Bill Index, an unmanaged index that is generally considered a representative of U.S. cash market. Index performance is not indicative of the past performance of a particular investment. And again, past performance does not guarantee future results. Individuals should look directly at each of these scenarios carefully. So what is the scoreboard? Which asset class has the best performance? As you can see here on the chart, it varies from year to year. In 2008, cash had the top average return. In 2009, and the cash alternatives posted the best return. In 2010, stocks fared best. 2011, bonds took the top spot. And finally, 2012 to 17, stock won the day. So over any 1 year period, one asset class may be increasing while the other may be falling. Keep that in mind. Let's talk about dollar cost averaging. What is that? Dollar cost averaging in a falling situation. The next investment strategy. What is this strategy talking about? Dollar cost averaging, which involves a systematic investment in a fixed amount at a regular interval. Instead of trying to time the market, you're investing in a regular schedule. That means you're automatically buying more shares when share prices are lower and fewer when they are higher. Here's an example. If you invest $500, as you see here on the screen, per month in an investment whose price per share was falling, at the end of 6 months, you would have invested $3,000 and purchased 109.5 shares. A bit of math reveals that your average price per share was $27.50, but your average cost per share, the price you actually paid, was only $27.39. Keep in mind that dollar cost averaging does not protect against the loss in the declining market or guarantee a profit in rising markets. Dollar cost averaging is a process of investing a fixed amount of dollars in an investment vehicle at regular intervals, typically monthly, for an extended period of time, regardless of the price. Investors should evaluate their financial ability to continue making purchases through periods of declining and rising prices. The return of principal value of stock will fluctuate as market conditions change. Shares, when sold, may be worth more or less than their original call. Again, this is a hypothetical situation using illustrative purposes. It does not reflect the actual or expected performance of any investment product. Let's do the same dollar cost averaging in rising, right? What happens in this illustration again? So look here. If we guess again, invested $500 per month into an investment whose prices are rising. At the end of the 6 months, again, we invested $3,000 and purchased 105.6 shares. The average price per share was $28.50, but the average cost was $28.40. Dollar cost averaging is a long-range plan. An investor is looking to benefit from the called averaging. A strategy helps maintain a disciplined, I repeat, a disciplined investment approach despite any nerve-wracking swings in the financial market. When others may be tempted to give up on the market, investors who practice dollar cost averaging invest a specific amount on regular intervals. Again, dollar cost averaging does not protect against the loss in declining markets or guarantee a profit in rising markets. Dollar cost averaging is a process of investing a fixed amount of money in an investment vehicle at regular intervals, typically monthly, for an extended period of time, regardless of the price. Investors should evaluate their financial ability to continue making purchases through periods of declining and rising prices. The return and principal value of stock prices will fluctuate as the market conditions change. Shares, when sold, may be worth more or less than the original cost. This is, again, a hypothetical example used for illustrative purposes only. It does not reflect an actual or expected performance of any investment product. Okay. Health costs in retirement. In the final area to cover in a balanced portfolio. In this illustration, as you can see, an investor created a more conservative portfolio. The investors invested $100,000 in a portfolio with an allocation 60%, wow, in cash equivalent, 20% in bonds, and 20% in stocks. For a 20-year period ending December 31st, 2017, the hypothetical portfolio generated an average return of 4.31%. The investor's initial initial 100,000 investment increased to $223,625. In its best years, this portfolio posted a 10.46% annual return. In its worst years, it would have lost 8.29%. Stocks are represented by the S&P 500 and bonds by the Citicorp Corporate Bond Index and cash by Citigroup 3-month Treasury bill. Index performance is not indicative of the past performance of any particular investment, and past performance does not guarantee any future results. Individuals cannot invest directly in the index. In retirement, being very conservative. Let's look at the balance of your portfolio in this next illustration here. Again, the investor here is more aggressive. Same 100,000, but we allocated 80% in stocks, 10% bonds, and 10% cash. For again, the same 20-year period, the hypothetical portfolio generated an average rate of return of 6.7%. The initial investment of 100,000 grew to $367,707. In its best year, the portfolio posted 25.3% annual return, and in its worst year, it lost 30.4%. Again, allocation makes a difference. Now let's look at rebalancing, the last strategy. Time and intent, as you can see here. Balancing is not a one-time event. It is an ongoing process. That's because time can change your portfolio profile. If overlooked over a period of time, a portfolio may take on a completely different degree of risk. For example, let's consider this hypothetical portfolio, which started here in 1997, December 31st, with a balance 50% bonds and 50% stocks. What would the portfolio look like in 2017? It would have shifted to 44% bonds and 56% stocks. That's more aggressive than the original intent. And that's where rebalancing comes in. Periodically rebalancing the portfolio may help it continue to reflect your intent and your risk tolerance. So where is your money? You take a quick quiz right now, looking at your situation. A quick exercise, if you have the numbers here, how is your money allocated? You drop in the percentages there. How much of your money is invested in cash equivalents? How much of your money is invested in bonds, fixed income, stocks, and speculative? If you know those answers, plop them in now. Let's take a look. It's a valuable look. Take the time to evaluate this. We've just seen a scenario or seen series of pie charts that showed hypothetical portfolios. What does your investment mix look like? Where is your money invested right now? Make sure your account for all of your investments. That would include your rainy day funds, your money set aside in a qualified retirement plan, everything. Many find this exercise to be a bit difficult. Never did it before. They've never thought about their investments by asset class before, let alone try to figure out how well balanced their investment approach is and whether it's consistent with their investment objectives, their risk tolerance, and their time frame, which is critical. If you don't know where you are, How can your map a path to where you want to be? Elements of sound investing. Putting a sound investment strategy can potentially make your investment efforts more effective. But it doesn't end there. Effective investment requires an ongoing effort. And there's a lot more to know. Here are some questions that arise at different stages in your life. On the screen here, a couple of different couples. First, we have Anthony and Selena have a growing family. And they're wondering, what is the fastest way to amass enough money to buy a vacation home? If Dave and Christine are in retirement and they ask, how do we shift our investments to generate more income? Then we have Rebecca, a single woman with a small business, and she wants to know, how should my business affect my investment decisions? And last, we have Isaac, who has done some research online, and he asked, the market's been volatile. Should I increase or decrease my stock holdings? And the answers, I'm sure, will depend on a unique situation. Regardless of your investments you select, following smart investment strategies is an important step towards pursuing your long-term investment goals. And that's where we come in. We specialize in helping people just like you develop and implement a sound investment strategy. Are you ready to get started? If so, schedule a complimentary consultation today, and we will be happy to do an individual analysis of your circumstance. I thank you for your time today and hope that this financial literacy series was helpful today, as we looked at the 5 smart investment strategies. And again, we are here. We will be here every month, the 3rd Tuesday of the month, with another series, a topic that I know will be educational and informative, if not just for yourself, for your family and friends. Again, I thank you. I am Benjamin Levy. You do have my contact information. My direct dial is 610-771-1043, and that's 610-771-1043. Or my email, you can reach me at benjaminlevy@htk.com. Again, that's Benjamin Levy, my first and last name, at htk.com for any follow-up questions you may have. Again, we are recording these presentations, so we'll be available for review for later. Please pass the word on to family and friends. Know that we're here. Resources in your community is just a phone call away or an email. Again, giving you back the balance of your time today. Appreciate all of you. And we'll see you next time right here. Financial Literacy Series. Y'all take care. Bye-bye.